One sec. Hey, everybody. I'm just waiting Facebook to come up here. All right. Welcome to Master Trader Live on Facebook. Today we're going to talk about, are the markets going to crash based on these trade wars? Let's get ready.
Simple market analysis and education to help you make money in the markets. Join us live each week on Facebook and see past episodes at Master Trader Live. Co-hosts Greg Capra and Dan Gibby.
Hey, welcome back. I'm Greg Capra. I'm joined by Dan Gibby, and we're the team behind MasterTrader.com. Sign up for our free chart of the week. You get timely market updates, lessons, different views on stocks and the broader markets, and educated about investing and trading. So let's get started here. So are these markets going to crash based on what's going on with these trade wars? Markets have been a little crazy of late, and let's take a look at the charts, have a little discussion.
But you know what, Greg, let me interrupt you right there. What made you even want to ask if the markets are crashing? Because that's going to be an important part of our analysis and why it's a timely subject today.
Well, anytime the markets get volatile and make sharp drops as they have.
But these drops are nowhere near compared February and March.
Well, true. But, when it starts, the question becomes, how far can this go? Especially when there's this kind of uncertainty about, okay, who's going to blink?
Well, in another part of it that I was kind of suggesting that we will get to it in the broader market review is this sensationalism. So what I was kind of suggesting was it's the media, it's newsletter writers that are putting these headlines out, either because they just want to be in the headlines, because I don't know the basis for them saying that. I mean, everybody has a story. What was the reason for the crash in February and March? I don't even remember. Was it Rocket Man? Was it trade wars back then? But it seems like the media is always looking for something to put on their storyline.
Well, sure. I mean, you have to get people's attention, and, so markets get uncertain and start acting like they do, and fear and greed is what the market's about. So what are we all afraid of?
So, all right, so
losses. And
right. So let me ask you this. We all know Harry Dent, who, became famous or infamous, whatever, when he makes these crazy predictions. When the Dow was whatever it was, 10,000, he's calling for Dow 1,000, and now he flipped his story and is calling for Dow 40,000. But regardless of that, my question, which I think might be a good kind of framework for how we're going to tackle this today, is you and I like using the word objective, which means, you can go look it up in Webster's, it means existing in fact, presently observable, as opposed to subjective, which is, the wishes that you want to happen. So my question to you is, with today's subject, what is going to be our objective approach to answer the question of whether the markets are about to crash or not?
Well, that's an interesting question, Dan, because twofold. In reality, the actual prediction of it, is it really going to happen? We do look at objective information. And at this moment in time, there isn't anything to suggest that it's going to crash. That doesn't mean that there can't be volatile moves. The other part that everybody was interested in this about is, how do we anticipate and avoid such an event? As well as everybody wants to know, how do I get in before the big move happens to make the money, whether it's up or down? So right. What we do is look at the objective information and say, what are the probabilities of such and such happening, or is this happening? Or are we in a situation where this is just nothing?
And so I would just let's just maybe categorize some of the areas that we're about to review together live right now. So it would be technical analysis of the broader markets. It's going to be market internals, both breadth and sentiment. It's going to be some intermarket analysis. You've been dead on tracking the yield curve and the high probability signal that an inverted yield curve gives, suggesting an impending recession, even though we'll get into it, that can happen 6 months later. But that's been some recent talk all over the news, is recession coming because of yield curve. And again, we'll get into it momentarily, but it's not a concern yet. And then sure, there's some fundamental aspects, which are these trade wars, because that's going to be fundamental if it affects companies' bottom lines, which is profit, which is going to affect stock price.
Sure. So, and because of it's such a news sensitive event, one of the things that we've been discussing with subscribers in the letter that we're in the our chat room is that, look, what's happening in the moment is real. However, the president or someone else in Europe or China comes out and says something else, and what was disastrous in the moment all of a sudden is opportunity heaven, and everything is turned around. So it's not your normal situation. Whereas the markets, yes, they did get extended. Our internals did signal that there was risk on the long side.
Right.
However, with this, and the tops and bottoms usually come without this big news event in the moment. So where this began. So it's a touchy situation, and that, like the big down day that we had a few days ago, or was it this week or the end of last week, whatever it was, someone says something else and hey, it's right back up again. So it's a little bit of a touch and go situation. And what we do, especially on a real-time basis, is put that all together as to what is our objective here? Is it day trading? Is it intermediate?
Right.
And, that's, as we look at the charts, that's what we define.
Right. And then, oil, as we know, has been on a tear. So that's another fundamental kind of intermarket analysis we can look at. But yeah, why don't we take a look at the broader market indices? And another point, which we'll see here when you pull them up, is that they've been telling different stories. The diamonds, the Dow 30 ETF, has sold off the most because of the trade war stuff, because they're multinational companies that are going to feel it more than typically the Russell 2000, which has more regional banks, biotech, smaller companies.
Right. Where they're not as affected by the dollar and currencies because they're more local. But
right.
That is part of looking at different parts of the market and saying, where's the money flowing into and out of? And that changes, which kind of throws off many because of, human nature, which doesn't blend well with the markets of wanting certainty. So last year, the Russell was the laggard. The transports were the laggard. Now, all of a sudden, the Russell's the leader. Can we believe that? Right? Whereas we look at the chart and say, well, there it is right in front of your face. Believe it. So the markets are always interesting, and we're all always students of the markets, but we always have to keep our heads in check as to focus on what's real. And that, to us, that's what's on the chart.
And that's such a powerful statement. Focus on what's real and not the noise, correct? Or your subjective wishes, or an email trying to sell you his magical oscillator signals that you can just red light, green light, and he makes money and doesn't care about what your account does, and he moves on.
Yeah, the red light, green light argument is powerful in the moment when you see all of the examples from the past, how it worked. And when you start using it and the market environments change and you're pressing one of my buttons down, what you're good at doing, is the indicator methodology, hocus pocus, holy grail, search for that is never ending and a black hole. So just looking at the price charts in multiple timeframes, which is what we're going to do right now, and explain that, all of you that are watching and listening, I hope we convince you to get all of that spaghetti screen off of your chart and focus on what they're all following, which is prices. Well, let's take a look.
Right. And if you're just joining us, welcome. This is a Master Trader Live. Today, we're addressing the timely and always important question, both for risk management and for new opportunity, of whether an impending market crash is coming, like has recently been in various media.
All right. Let's see if we can get this
We're going
lined
to start
up here
right now by analyzing the broader market ETFs on multiple timeframes.
All right, so we're going to view this with one chart for the moment, and we could look at multiples, but I think it's easier to start off simple, Dan.
Sure.
Right? And, I got if there's questions, of course, throw them out there. So I've got the S&P 500 up here. And, when we look at it with the amount of information here, we say, well, it looks relatively controlled in the moment as to what's happening. But that big down day, right, 3 days ago, if you were in front of your screen, that was a pretty big event. Right? That's a large bar where it gapped down. So what we were doing at the time, which we approach things in the same way, a methodical way, is as prices were pulling back here to this, what we call minor support, and buyers began to step up, of course, we're looking for longs. And one of the things that Dan and I do is we combine multiple time frames to get the best opportunity for reward to risk, meaning if we can get in near the turning point where we've combined multiple time frames in our entry, which has the biggest upside potential, fantastic. So
the swing market internals help us, give us more confidence on reading just price action. For example, you can point to where right at the high, the market internals on sentiment signaled
right here,
we aren't going up anymore.
Right. So those market internals give us that guidance as to, hey, does this information line up with the price data? Right. And it did at the high. And it's hard to not fight, but say, hey, this is the turning point, or the turning point is at hand, which we were saying to subscribers that, sentiment has gotten too far here. There's too many bullish traders looking for prices to go higher. And the turn eventually comes. It doesn't happen in a split moment. So, but it lined up with resistance, but an uptrend is supposed to take out resistance. Whereas the pullback here, the internals didn't tell us that it was an outright buy. Didn't mean it couldn't go up, but we didn't get that setup. But we did find opportunities, right, Dan, with options at that time as it pulled back.
Absolutely. And just to elaborate on that, at Master Trader, everything starts with a bias of what we're trading, a stock, ETF, commodity, currency. And based on that bias of bullishness or bearishness, we either do a directional trade where we're looking for a big target, either stock or option, or we throw everything else in an income trade bucket. And what we do there is just sell out of the money credit spreads around these turning points in these patterns, and we collect the money as our profit as long as the stock doesn't close beyond that short strike.
Right.
So they're easy. Today we found 5 of them. I actually got an email from a subscriber saying, whoa, I'm old, slow down. And I haven't responded yet, but the answer is we are purposely slow and stay out, not slow, inactive, and we stay out of harm's way when the odds are not high probability setups or conditions. And when things do come in alignment, we like to say we push the accelerator because it's our time to make money because everything's lined up.
Right. On a side subject, Dan, us being in the position of suggesting to others, here's a trading opportunity to make money. So at times you can feel, I don't know, I would imagine you do, but sometimes I feel like, hey, you know what? You're here to tell others what to do. And when we have to tell others, hey, don't do anything. And there are times where you and I are like, for hours, I mean, even from an intraday point of view, sit on your hands, folks. There's nothing to do. When the opportunity's at hand, we will take advantage of it. And now, you're saying, hey, someone's emailing you and saying, hey, slow down there, son.
Well, a week ago, I got 6 emails from subscribers to our weekly option trader, which is our service that all it does, it specializes in selling these credit spreads 10 days or less because of the rapid time decay that's inherent in selling options. And we got emails saying, does my Telegram work, my chat message? Because I haven't got a trade from you guys in 2 days.
Right.
So
Right.
those are the 2 outliers.
And things often happen that way, meaning, so I set alerts. Like, so when we see things setting up, I can't watch them all. It's impossible. So I use the computer. So you have to be careful about setting too many, because then all of a sudden it's just overflow. So you have to focus at the time,
and then many times the ETF is our go-to. Yeah.
Right. So we can find so many opportunities. It's incredible. But at those moments where there's the shift, we sit out and we wait a little bit. And we find lots of opportunities today because the short-term strength. But the question is, where's it going to go? Is this going to crash? Is it going to go hold on to this turn right here? Or is it possibly going to be a measured move lower?
Well, 2 things, if you don't mind explaining measured move to folks. And number 2, on this time frame, as folks know, and as is your expertise, is you're always drawing 2 or more scenarios to play the movie, so to speak, that if this happens, this is what I'm going to be thinking. So my second question for you is, since today's episode is the market going to crash? And we haven't looked at weekly or monthly charts, but they're still in uptrend. So, the answer should be no. But on this chart, what would make you start to think that maybe it might crash?
Nothing.
All right. Well, you got to elaborate on that.
Yeah. So
what if, all right, I'll ask a hypothetical. What if we gap below the May low tomorrow? Now, I know you and I are going to be thinking to, play long the bounce, but I mean, from a longer term perspective, that would be a pretty ugly gap.
It would be tremendously ugly. So, from a long-term perspective, the broader markets, what is a big gap for the broader markets? A big gap overall,
right?
1%.
Right. So
a gap of that magnitude would have to be created by some monster event. So
Correct.
That in and of itself could be a buying opportunity. So how do we determine from that point whether it could crash? Because all crashes do start with an initial big move. And then there is some type of retracement And that is where the real devastation comes. So if you go back to 1929 or different points in history, it doesn't just crash from the high, right? There is, hey guys, wake up here, something's changing, right? So a gap of that magnitude, we would then watch to see what is the reaction to this support down here.
Okay. And then secondly, without me even looking at the weekly or monthly, that a gap that big would damage the weekly and monthly, pretty severely too.
Well, you would think so, which we could look at.
Right. 2580-ish. I'm eyeballing it.
Right. So, all right. So it's big support. Now, you've presented this idea to me and thinking, well, if this was to gap down there tomorrow, the first thought that would come to mind in the moment would be to sell naked puts out of the money, because I think that would, and I use the term cautiously, free money.
Well, so, we would use intraday charts, of course, because it might sell off another 100 points before we sold those puts. But I'm told you that once we got our intraday turning point, if the spiders gap to 2580, there's 100% certainty that the volatility index is going to gap significantly higher, which spikes the premiums in the puts. And that's when we love selling our credit spreads, is when volatility has skyrocketed. So that typically occurs after sell-offs, which is why our subscribers in February and March and in May, all of those bottoms there and reversals at the 200 red moving average, right, we were selling out of the money put spreads like wildflowers.
Right. So let's just start with a little bit of a easier or less volatile scenario as to what's happening right now. And I would use these lines in the sand, so to speak, to say something of more significance is happening up or down. So prices, the S&Ps have held in this area right here initially. Gapped up this morning, acted well, little retracement going on here. But as far as a turnaround of this move, it's maybe a start, but in reality, nothing. It's just a little technical bounce here.
Okay, start of what?
A start of an actual reversal. So where prices have come down to a reference point of support where buyers are going to be, right? And here's support right there.
Okay, right. Okay, so let me just back up again. Since today's, and maybe that's why I came with my hypothetical of 2580. Since today's session is the market going to crash? We haven't actually defined what crash is. So even if we took out that prior low that you have circled there, that's not a crash. We're just in a big sideways trading range.
Correct.
So how? I hear some people on CNBC predicting a 30% retracement from current levels, 50%. That's a crash. So for today's show, Greg, how are you defining crash?
A very fast momentum move.
Okay.
That lasts for an extended period of time, meaning one day doesn't make a crash. It may look like a crash or intraday. So if we were to look at this from an intraday point of view, we could see the picture of what a crash is in a small time frame.
Okay.
Right. So it might be interesting. I mean, so when we define that, and we could look at what is a crash and then look at an intraday time. Well, this is a mini crash right here on the daily chart.
Correct. Okay.
It's correct. A vertical move that doesn't bounce where you think it should based on the technicals. it basically slices through support as if it's not there. So extreme fear and selling that is dwarfing whatever demand that there is.
Okay, all right. So we're talking mini crashes or whatever, not the 30, 50% correction that some CNBC bears are talking about.
I don't even know how they come up with that other than just creating fear.
Right, because what we're looking at today, nothing suggests that on the indices, and we'll get into the yield curve and the other objective data.
Right. So, I mean, we haven't even looked at other time frames yet. So when we think of crashes, right, we think of extremes in greed, where this was a bit of an extreme in greed. And this is where we alerted subscribers, be careful here. This could be a breakout bar failure. And that's exactly what happened. Now, breakout bar failures don't suggest this is what's going to happen, but at the time, I don't remember what the news was, but things came down hard and fast at that time. So the first thing as far as crashes goes is you typically have an extreme in greed and a strong momentum move that becomes extended. And so you might say, aren't we extended, based on longer time frames? And we just need to look at that because the markets have been going up since 2009.
I mean, since that the banking crisis bottom, exactly March 2009.
Right. So here's the monthly chart, and this became extended, and then we had a wide range bar on the monthly, all the things that we talked about at the time, and based on internals, what we told subscribers was that here where we don't have an inverted yield curve, we don't have the scenario for a big bear market or crash. This is a scenario that where we could see a year of choppy price action,
right,
before going higher. So everything we do is a very systematic approach. And for those that are listening, what do we do from here? Well, we're in what appears to be just that consolidation. How long it'll last is unknown. But if we use this as a measurement right there, that's where I come up with the scenario that it could be normal to last a year or so of going sideways. That's what happened here.
Yeah, that's a good comparison for sure.
So, I mean, we could go the rest of this year chopping around. Now, what if, right? We always have what if scenarios. If it makes a new high, this then becomes major support on this long time frame. And a move under there after a new high would be a bearish signal because it would break the trend on this time frame.
Absolutely.
So that's something, those that are listening, a very simple way of determining for yourself from a long-term point of view, has the market, something changed in the market of significance on a longer time frame? If it makes a new high and breaks below this low, it's no longer in an uptrend on that monthly time frame.
Right. Wow, Greg, I'm just, how I like looking at charts and it just jumps out at me a compelling long or short. Look at the presidential election setup right there at the end of, 16 there. We had the master trader bought to the right a little bit. The master trader right there, there. That was the election.
Right.
Wow. And we were recommending a lot of directional trades then.
Right.
Wow.
And everything, everybody, of course, we turn on the news, what's happening there in the world, especially during a presidential election. As technical based investors and traders, we look at the charts, and sometimes when there's a big news event, most times it's difficult to say, just look at the chart and do what it says, because just human nature makes it difficult. But When that reversal happened, well, what was setting up initially anyway was extremely bullish. I mean, this area right here certainly looked like prices could decline sharply
Right.
before the turn. Right? But the move under the lows and the bottoming tails and the wide range bar moving up. And one of the concepts that we talk about almost on a daily basis, even on an intraday, because the concepts are applicable to all time frames, is a wide range bar igniting. What happens after that? Our rule says the candle bodies should stay in the upper half and ideally in the upper quarter. And it did. Yep. And then this bottoming tail bar here that took out the lows, I look at something like that and it's like, damn, this is like the moment in time to make big money.
All right.
And initially moved up, and you could trade this pattern on a 5-minute chart, an hourly chart, a daily chart, universal. But of course, the election was going on. Who's going to win? What if?
You know, another thing I just thought of, Greg, talking about, sentiment and our comment about trade what's in front of you, trade reality, trade objectively and not your subjective wishes. For some reason, I just thought of, Mark Cuban, the businessman out in Dallas, Texas. And he was saying, if Trump wins, I am shorting the heck out of the market. We're going to tank. And, there are many other, bearish Trump followers. And so Mark Cuban and or his, team of traders, whatever the case, shorting the market was not supported by this monthly chart.
Well, that's absolutely correct, but they probably don't look at charts. And
I don't know what they look at. Right. I don't know.
Right. So, I mean, they could just be their feelings that, if he becomes president, it's going to be a disaster. Right. A lot of people had that opinion. I mean, he was an unknown as far as, I think like myself, it's just like I've had enough of the political bantering and promises. Right. And so anyway, you remember after the election results came out, the market tanked almost 1,000 points overnight.
Yeah. Right. I recovered.
And then it reversed.
Right.
And so at that point, look, if you're looking at charts and you say, look, this guy, I don't like him. I think it's going to be a disaster. And you look at the chart and you say, well, someone else, a whole big group of people that knows more than me are saying I'm wrong.
Well, yeah, it's not political. The stock market and profits are saying they like what's going on and what is expected to be coming down the road.
Correct.
But Greg, just as it's 12:33, why don't we take a quick look at the other indices, and then Tony has a great question for us also, and then we can. I'd like to show people the yield curve because you're a master at that. And
I have to open a different program to do that, but we can look at it in a different way so that I could explain it for sure.
Yeah, that's fine.
All right. So, this is the weekly chart of the S&P, and you could see this is just a normal pullback from this prior high. And we still have a couple of days to go, but we're getting a bottoming tail bar here, which is great, because it's a higher low within this uptrend within this consolidation, which would suggest it's going to move higher. But let's look at the other indices. So the NASDAQ, right, there's the daily chart, which was outperforming. And now it's pulled back. And it's certainly, you could see more in question as to its probability of going up. And this doesn't look anything like the S&P.
Right.
This is a situation where you can't throw the dart and make money, because here the NASDAQ outperformed, the S&P and other stocks and sectors underperformed. So you have a moment in time where you have sector rotation and money coming out of some of the winners, right, flowing into some of the losers, which that in itself is supportive of a bias that the market's not going to crash because money's going into losers.
No, so that's an excellent point, and I was just going to add one just from this trend. And I have friends and family indicator that they've been asking recently, and that's another reason why we're having this show today. They're like, "Is it time to get out of my my IRA stuff, hold long-term holdings?" And I sent them a picture of this on the monthly and weekly. There's nothing here to suggest a crash whatsoever.
Absolutely. But as you especially, were teaching and telling subscribers, certainly look at time to sell some covered calls on long-term positions, or even if you owned the Qs at that time, to sell an out-of-the-money call when it stalled up there at the high.
Absolutely, or at the money call, correct. No, the retracement, yes, we're in the middle of a retracement, correct. We're just differentiating, a crash versus a normal pullback.
Right. So looking at what's happening right now, I mentioned measured move. If this closes this way, right, this topping tail red bar, in the context of this move under this support, well, that is suggestive of a measured move, which is, you've got to move down, and then basically you just project to the downside where it's likely to go, which 99.9% of the time it lines up with the next reference point of support.
Yep. And we would actually prefer this to get our market internals more extreme, to give us more confidence for a bullish turn. Right now, we're still taking it day by day.
Right. All right. So what we want to see is breadth and sentiment at a bullish extreme. What does that mean? Well, we monitor what option traders are doing. And I call them the wrong way traders, wrong way option traders specifically, is that they jump in at the worst possible time. So where they were loading up on calls, bullish bets versus puts, bearish bets here, which said, hey, odds are the market's not going to continue to go higher without some type of corrective action. Down here, I'm sure they'd be betting on a crash. It's just what they do historically every single time. And when they do that, we then look for bullish patterns, which could be this, something like that. So another thing that we teach students is that don't get hung up on one pattern. If you understand what I coined bar by bar analysis, you'll always be able to figure out what's happening in that price action without thinking about, Haramis and dark cloud covers and morning stars and all of that hocus pocus. So this conflict between the Qs, right? Well, the spiders are starting to take on that kind of a look down. They looked a lot better this morning.
I agree. I'm watching it over here.
Yeah. And so we'll see where this ends up near the end of the day. This could be a big green bar, or this could turn red. So we'll see what happens. Right? Just in a moment of uncertainty here, but as much as I'd like to see the markets go up, I kind of tend to like to see them go down to that support, because there'd be a great opportunity where the internals would be lined up with, support and resistance, and you get bigger moves.
Exactly.
Right? So let's look at, this is what we do. We look for agreement between markets at the greatest opportune time. They do line up. So the Russell that we spoke about, which has been outperforming, has now been underperforming a bit. And Dan, I'm looking at these charts in real time, and if this closes this way, I'm looking for the measure move lower.
I agree.
I think, when we get back in the room, we're going to have to find some opportunities to take advantage of that. But we still have time for this. We look at the transports. See, now they're down at the 200 period moving average, the red line. So can it go through it? Of course. But this, let's assume it goes down, it's going to go down less than the Russell, because what's outperformed historically begins to underperform and do a lot worse during a corrective phase. Now, back to what I was saying in our discussion, Dan, before, was that because this is a news-driven market at the moment, whether, China comes on and says, hey, Mr. Trump, we want to play nice here and let's go to the bargaining table and work this all out. This bearish pattern probably evaporates in the blink of an eye.
Well, and there was an interesting pre-market reversal also on trade war news, which kind of surprised me because I thought it was live in the moment because of the bullish reversal. But I'm reading the Wall Street Journal this morning, which was printed last night, of course, and I didn't know why the bullish reaction came out to news from yesterday.
Yeah.
Something changed, but
Yeah, I mean, not everything is available to us. That maybe it is, and we're not reading it. But there's so many things that we could discuss, Dan. Is that even myself at the beginning, like you're searching for at that time the indicator or whatever it is that's going to give us the sure thing, and you start to look at so much information that you get into the analysis paralysis syndrome. So you eventually come to the acceptance that you're never going to know everything. Look at the chart. Does it make sense? Proper money management saves you from disaster. And you just go with what is at the time. That is, it lines up in your plan.
Right. But yes, we go with what's is, but we do have different levels of confidence. I mean, in our green room, our live trading room, we get questions all the time. Hey, Dan, Greg, what do you think about this? And I say, it looks okay, but I'm not that confident because there's conflicts, whether it's multiple time frames or the broader market indices, internals. And I'm like, I'm not entering the trade because I'm not as confident as I want to be.
Absolutely. What I said this morning in the room was, I want to see these multiple timeframes coming together, because when they do, we have the opportunity, I use the phrase, press the accelerator. And what does that mean? It doesn't mean go mortgage your house, and buy call options. It means to intelligently up the bet, that you're at a moment in time where you may go all in with different ETFs and stocks and options versus, hey, I'm going to buy call options on the S&P 500 and, make a killing. No, right. You do it intelligently where you can. Whereas, right now we put on different positions that we believe that are going to work out over the next few hours or the next few days, and then assess what's happening. Interested, Dan, our utilities here are holding up, right? But they've reached this extended point, and we're looking for this to reverse. And this is interest rate sensitive, so this is another intermarket analysis part that we can monitor. And Tony was asking, can we use market internals with a put-call ratio? Now, I would assume so, Tony. It's not something that I monitor, but looking at put-call ratios on a particular commodity probably would be of a benefit to do that. Again, it's not something that I monitor. I just look generally at what the equity option traders are doing. Calls versus puts. And there's also an index put call ratio, which is historically always bearish because it's of hedging. That's pretty much useless to use. So the equity put call ratio is what I use. And, it's been so reliable that it's foolish to ignore it.
That's a good comment right there.
Yeah, I mean, we all searching for valuable information to help us make money or stay out of trouble. And it's one of the most reliable things. And when you combine that with breadth, which is what we do, and look for the alignment of the two, the accuracy is phenomenal.
Can you
I've been doing this for decades.
Can you show any of those or the yield curve?
Well, I can show it to you with this platform, which it is. Let me just see here. Okay. So this has a few other things on it. Your screen will change, and I'll make this a little bigger here. So here was the point in time where option traders got so bullish on the market that was like, it has to go higher. And you could see it wasn't quite exact to the high day, but we had the warning. And it's interesting, and we not always, but often look at the market as the market knows what we're thinking, kind of like to throw us off. So at that time, Dan, when I started to say, option traders are loading up here on calls, it's time to be cautious, or the market's going to correct. It didn't do it right away. And it's like, how are you not doing that? And you could look at where I'm scrolling here.
Right.
The NASDAQ actually went up a bit further, as did the Russell over here. And then came the breakout failure. And that's called, like I say, that is it. There's the shock.
Right.
It's kind of like somebody saying, put a fork in it, it's done. And here we have now, we still have the rest of the day as to what's going to happen, but this looks like the measured move lower.
Yep.
And what we are going to be looking for in the coming days, if that happens, is the alignment of these internals to move in alignment where we have option traders loading up on bearish bets, and these lines will move up into this area, and breadth will become oversold, which basically tells us that the stocks that are being measured, many of them are getting creamed, to the point where it's become excessive. So excessive corrective action, option traders betting that it's going to continue, sets up scenario historically for the market to turn around and go back up. And this is where we then start to use multiple time frames and bar by bar analysis and putting this all together to take on positions from an intermediate term point of view, as well as option strategies, which at that point in time, and Dan, I know you don't like when I say this, but essentially free money.
Well, it related to that, I was going to ask if you can scroll those back to February, because that's when we had that mini crash and the spiders, and the McClellan, I remember, got to like almost negative 350. And I remember you telling me, you're like, Dan, I've never in my career seen the McClellan this low and the market not reverse.
I don't remember saying that. I've seen it pretty low, but maybe so.
Well, but we were coupling that with the other sentiment indicators. See, that's what I wanted to show you. See this, they're in alignment is what I'm getting.
Right. So historically, this, and when it goes down there on a particular day at the close, down around minus 300, you could use that as a guide. You're a day or two within a bounce. And it's going to be real ugly at that time when that happens. But when we see, right, this is
the February one here.
Right here. Well, this is where you were actually getting the bullish divergence.
Yeah, we're right. We did them both times. So we're two crashes, right? A retest of it.
Right. So there, I'm trying to line these up, and it's not lining up exactly, but you can see where the cursor is about in the same place. So what we do is we wait. Here we're getting a signal, and then there it reaches an extreme. And of course, we line that up with what's happening on the chart, which is, you can see as I'm scrolling there, and we can look at that in all of the markets.
And that's when we did a heck of a job selling those put spreads.
Right.
And we did them 3 different times. I mean, I can see them right here.
Right. So
that's the beauty of our breadth and sentiment indicators. So Greg, again, since we're talking about a crash, and maybe we can, finish shortly looking at the yield curve, because I know that is a longer term gauge. But my question to you, for the benefit of the viewers, do you have longer term breadth and sentiment indicators that you look at that would help answer the question of today's show of an impending mini crash?
They wouldn't tell you that.
Okay.
All right.
So they're more our short intermediate term signals.
Well, I use this as, a combination of this is short to intermediate term sentiment and breadth.
Correct.
How far does this get down? And historically, an extreme would be down at minus 300. And then from there, that kind of a deep correction would result usually in a new low, where this would do exactly, what's happening here is that it shows that there's some relative strength within many stocks. Now, when we're looking at the monetary part of this, the yield curve, what we're looking at, I don't have the 30-year in here. I'd have to look up the symbol, but essentially it's really, really very, very simple.
Sure.
As to, you see this here, and the way this platform shows you, this really should be 2.8, right? As to what that yield is. But in any event, what we're looking for, just remember, 28.44.
Right.
And this is starting to move lower, which is definitely a concern because, and we're going to more economic numbers coming out tomorrow and Friday, which do they confirm all of this talk about this exploding greater than great economy, job numbers and GDP and such that are going to be reported? They better be awesome numbers. Based on what we've heard, right? Or who's not telling the truth here. So we've got this 10-year here, and let me just see if I can TNX. What do they use? Hyphens?
There you go. It popped it up for you.
TYX. There we go, the 30-year. So here's the 30-year. So, which is always going to be or should be a bit higher than the 10. That's right. Another point to watch.
Higher cost for money, right?
2.9, right? Let's say 2.9 or 29 versus, and let me just add this in here.
2.84.
T.
So that's 1.4% higher.
All right. So I've added that. All right. So there we got the 10 and the 30. Now, let's look at what is being followed based on a belief about what the Federal Reserve is going to do. And that's 3-month interest rates. 18. That's a big difference. It's way lower than the 10. And so what inversion means, right, by definition is, let's get my drawing tool, which would mean that those longer term yields would move below these short term yields. And that would mean that the yield curve, short term versus long term, are now inverted because the normal move would be for long term, right, to be up here, which is where they're at. So if these continue to come down, and right, the word is that the Fed's going to continue to raise interest rates throughout this year, and this continues to go up, that is what I would truly call a death cross. It's not the 50 and the 200, which we joke about, Dan.
Right.
That's erroneous information as to what is a buy or a sell signal. But historically, and it doesn't happen very often, it happened in 2000, it inverted. I think it happened in 2008, and it inverted, and we had big corrections at that time. So this is such a simple thing for investors to keep track of, which there are free websites where you can go to and just look at short-term interest rates and 10 or 30-year interest rates. And if the numbers invert, historically you're months and possibly even a year away from a very big bear market.
And no, but so let me just emphasize what you said for the viewers, because I watch the news just to see what they're telling other people. I don't watch it for my source of news per se, but there's many people they've been putting on saying, oh, as soon as this inverts, then a recession's at hand. And so Greg just confirmed to you through fact, not speculation, that no, it doesn't occur as soon as the day that it inverts. He just said it can take months to up to a year.
Right. And that's another way, if you think about the market of, is it trying to throw me off? Right? The market doesn't even know we're alive. When you think about it in that way, if the market's truly an entity. But things don't happen in the moment, whereas you get a bearish piece of information or bullish, it tipped the market, if you will, continues to trend and does not conform to the information in the moment, which of course raises doubts as to the validity of the information. But as we look at that information historically, it does work out where there's going to be a bear market, and we begin to reverse the analysis. Whereas now the yield curve moves to an extreme where, and what is an extreme? And let's say the 30-year is up here and the 3-month is down here, and the distance between the two would be like 3.5 to 4%.
Which you will see on your oscillator on your other page, right? I mean, the difference of the two, the inversion is going to hit extremes, right?
Pat's asking, have you ever noticed the news attempting to talk the market up or down? Are they successful? Well, I mean, we call, people in the news the talking heads, and everybody has their opinion as to what's going to happen, and they're going to present what they believe. Now, as far as the media, CNBC, I kind of associate them more like what we would call from years ago, SOS traders. And what does that mean? That means that their opinion changes as to whether the market's bullish or bearish on a day-to-day basis, which could be even on an hourly basis. They really are just, reporting on what is. So you can't really put any weight whatsoever. But what I'm showing you here, you can put your money on it as to what's coming and when change is at hand. And when we have alignment of these three market internals, monetary, breadth, and sentiment, and you combine that with technical analysis, the odds are overwhelmingly on your side.
Hey, Greg, that sounds like an awesome plug for folks to subscribe to the Master Trader Advisory Letter, since you track that every single week and are doing the homework and analysis for them.
Well, right. And what we do, of course, you're paying us to tell you where to go make money. But we also approach everything that we do as to teaching you to do it yourself. And so you may just say, tell me what to do, or you may say, tell me how to do it, but we do both. That's our goal every day, whether it's in the green room or whether it's in a letter, right? We'll tell you what to do. We'll tell you how to do it.
Right.
With that being said, Dan, let's go have some lunch.
All right. Well, yeah, pleasure being here with you and our guest today. Thanks for attending. I hope that took some mystery out of whether we have a market crash coming. And Greg had a nice summary there showing you and telling you what are the objective things to be watching to answer that important question.
Awesome. Guys, join us next Wednesday at 12 o'clock. Type MT in Facebook there to subscribe to the channel and join us. And talk to you then.
If you like the show,
Happy trading.
share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the show when you like our page on Facebook. Just visit mastertrader.com. That's mastertrader.com.